If you ever find yourself buying a stock or buying the index before it's ready to bounce, meaning you're catching a falling knife, then keep watching. This video is for you. What's going on, you guys? My name is Kyle. I'm a full-time futures trader and founder of Opinicus. In this video, we're going to be going over a concept known as the right side of the V. It's a very basic framework that's going to help you stop catching a falling knife and actually wait for price to bounce before getting involved. Now, I work with a ton of one on one clients, helping them develop profitability on their trading journey. And one of the most common issues that developing traders have is they're getting involved with a bounce too early. Now, typically, there's going to be rooted in some sort of FOMO. They don't want to miss the move. And so they're very eagerly anticipating some sort of signal. Whenever they get that first kind of little look of a bounce, they find themselves jumping in. And typically, this means they either have to sit in the stock or in the index through lower prices, or they get stopped out, or they have to sit through some chop. Now, this concept is going to help you avoid all of those scenarios. Let's actually jump right into it right now. And I wanted to start off with kind of a little visual graphic here. So the right side of the V concept is very simple, right? Here's where we would be buying early. Now, here's where we may be buying late, but late is not a negative here. Late is not a negative. This just means we are on the actual backside of this bounce. And what you'll notice here, just on the schematic, is that we have the same price point, right? So we have a price point right here. Let's just say that this price point is 100. Down here, we buy at 100. We have to sit through some drawdown, potentially taking a stop. Over here, if we buy at 100, our expected value is much higher. We have a much cleaner way to define our stop because there is a structural low, and this trade is going to have a much higher probability of working. Now, typically, buying the right side of the V, there's going to be a few different ways to actually do it. I have a couple of different ways highlighted on the screen here. Now, number one, this is going to be the easiest way to make sure that you're on the right side of the V. Typically, we see that price has put in a low. We know that price has put in a low because we have a pretty decent bounce. We have a bounce versus our level, and then price makes a higher low. Now, typically, this scenario, number one right here, is going to be the easiest to master for developing traders, trading that higher low after a low has been marked. Now, with scenario number two here, we have price moving lower. You have a pretty significant signal bar right here. So the low is actually marked with a very strong signal bar. Now, this would be known as a hammer. It's not a perfect hammer because ideally this hammer would be green, but nonetheless, it does have a large tail. And this is going to be in a location that is near one of our key levels or near some level of interest. We see the signal bar, we see that buyers are starting to step in, and that marks our local low, and we can be a buyer at that point. Now, imagine if we had bought on this less significant, this weaker signal bar right through here, this green bar right through here. Well, we would have to sit through those new lows, potentially taking a stop just to watch price do exactly what we thought it was going to do. That takes us into scenario number three. This is known as the spring. This is one of my favorite setups that we actually see intraday. It is going to be a more challenging setup to master simply because there is going to be a lot more nuance involved. Now, the spring, typically what's going to be happening here is price is going to be marking a low or what you think is going to be a local low. It's going to undercut that low and then quickly reclaim. Now, the challenge with this particular scenario is that if we take a look at a little bit earlier, right through here, we can see that price undercut this situation before it actually bounced. And so what that means is that there's going to be a lot of situations that are going to be fake outs. If you're involved with the wrong location, you're going to be getting involved in some of these scenarios that are not actually spring setups. That's why I said that this one is actually going to be one of the hardest setups to actually master, simply because, again, like I said, you're going to find yourself still with this same issue of getting involved too early because every little bounce, you're going to be thinking, oh, that's the spring setup, that's the spring setup, that's the spring setup. So this one is definitely more challenging to master. If you are just now kind of getting into identifying some of these reversal sort of plays, or starting to get involved with the right side of the V, if you will, which is inherently going to be more of a reversal type of strategy. You want to start out with the higher low scenario, which is definitely going to be the easiest, is the one that we work on the most in the trading mentorship group, and then with my one-on-one clients as well. From there, you have the true intraday reversal, which just marks the low with that signal bar. And then finally, we get the spring setup, which can be very explosive and very profitable, but again, is one of the more challenging setups to master. Now, following this clip, I do want to share a clip from a recent trading mentorship group where I'm actually going over this exact topic over live price action. So this was a particular day where I noticed a lot of traders were getting involved with a setup prematurely. I break down this concept with real life price action in Nasdaq. Let's jump to that clip right now. Someone had taken a stop shorting this, right? So the entry's premature. You want to wait for price to get either back beneath VWAP, ideally, or what we had discussed. If you go back and watch the live stream, if you weren't there, the scenario I discussed is you want price, if it's going to break above, let it flush back beneath, give you the retest, and you enter there. And then like 4 minutes later, that's exactly what we see, right? So remember, we have there's kind of that right side of the V concept, except in this scenario, the V is inverted. When we talk about the right side of the V, making sure you're not too early, bear with me here. This chart is inverted, and we're talking about this right through here. So you enter long through here, you're too early, right? We get more proof of buyers right here. And then again, and I just inverted it for the sake of the actual V shape. And then we have more proof of an entry right through here. Buyers step in pretty aggressively, right? You have your higher low right through there at the level of interest at VWAP, right side of the V, right side of the V. And what is significant about this is we're pretty much talking about, relatively speaking, the exact same price point. But these two price points, based on the time that you enter and the structure at play, have very, very, very different expected values. Very, very different. Very different. So I hope this is making sense. It's an important concept. The takeaway here is that a couple of minutes of patience can really just do so much. It can do so much for you. And yes, sometimes a couple of minutes of patience means you end up missing an opportunity. To me, that's okay, right? I'd rather miss it than try it 3 times and each time is a stop. I've been there. I've lived that. I hate that. Is that making sense? Let me know. Let me know if that's clear.